First of all, thank you very much to SF Consulting and team for inviting me today to share some of my experience in managing intra-group services. I am fortunate to be very passionate about transfer pricing and really coming across a broad range of industries and situations. So happy to be asked during the Q&A session on my presentation. So let me just start sharing the screen with you all. I hope that Jelita, can you confirm that what you're seeing now is the full slides and not with notes?
Yes, it's a full
slide. Excellent. So let me just start by explaining a little bit about the view on intragroup services from a headquarter point of view. And the reason why this is important to address is because there is an underlying, how can I put it, an underlying thinking or preconception that management services or service equal deliverably trying to shift profits from a high tax country to a low tax country. But the more and more I have deal and advise my clients, especially regional head offices based in Singapore, the more you kind of come to the conclusion that a lot of the times there are true commercial reasons that can support the reasoning or give basis to the fact that services are a necessity for a multinational to run its own business, beyond trying to move profits from one country to the other. And why does a multinational group has a range of services to be charged across subsidiaries? So as we know, there could be a wide range of type of services. So probably a lot of us are very familiar with the word management fee. But really, the word management fee can have different meanings in different organizations. Why? Because the reason for that management fee can be a wide range of type of services, starting from administrative or back office type to shared services such as technical or more value-added service like financial, marketing, R&D. So why do companies charge for services? There could be different reasons. One could be the need to centralize activities in particular countries. So there is no duplication of business units across the multinational group. And that is a very good reason as to why sometimes we have shared services where those services are concentrated in one country to use synergies rather than duplicating the same services across countries. And what that brings as a benefit to a multinational group is to lessen the cost associated with having duplication of roles in every multinational, in every entity of the group. Another reason why, in my experience from a regional HQ, there is a need to charge services is because, especially in our region, there is a lot of true regional entities based in Singapore that employed the regional team, from the region CFO to the region CEO to the, depending of the industry, the regional technical person or someone who specializes in a particular part of the business, and so on. So from a regional point of view, it doesn't make sense that your regional head office has to bear all the costs when the regional team actively supports the subsidiaries in the region. And what I mean by actively support the subsidiaries in the region, you all might be familiar that these regional teams before COVID, they will probably travel a lot around the region. They will go and support the subsidiaries in their own countries. They will hold different ways on supporting the subsidiaries by way of emails, calls, decisions, etc. So from HQ point of view, and IRAS particularly also, which is our Singapore tax authority, there is also concerns on Singapore bearing excessive costs that are incurred for the benefit not only of the Singapore revenue, but of the regional multinational group. And one could argue that that cost should be really borne among the whole regional HQ and subsidiaries, given that they are all benefit from that regional team. So then the question is, from regional point of view, or from regional HQ or ultimate HQ, what will be the ideal situation to set up a service transaction? So I think this has been one of the biggest changes after the OECD base erosion and profit shifting initiatives. I don't know how many of you practiced transfer pricing 20 years ago or 15 years ago. But when I started my career in tax, there was a very clear focus on services charges being able to set up by focusing only on step 4 here, which is the contract. So what that means is that a contract was sufficient to substantiate a service charge. But no one was asking about step 1, which was the benefit. Is there substance? Is there a real benefit? After base erosion and profit shifting initiative from the OECD that gave rise to the new transfer pricing legislation worldwide and in our region in every single country, really was about, okay, you can set up not only service transactions, but any transaction that is between related parties or companies of the same companies of the multinational group based on a contract, but that contract has to have a basis or a substance, a commercial reason, other and beyond that. And that's where we come to step 1, which is benefit. So as a result of OECD BEPS action plan and the new language in all the transfer pricing legislations and guidelines across the region, and I will probably, Gandhi will discuss the implications from Indonesia point of view. We are now really looking at these 5 key steps, with step number 1 being critical. There has to be an evidence of benefit. And that is obviously a clear point for both HQ and subsidiary, and Gandhi will talk a little bit from a subsidiary point of view. But from HQ, if HQ is really applying proper policy, they should also look at what is the benefit that they are offering to the subsidiaries to be able to implement the service transaction and as a consequence, the service charge. Then the second step is to look very clearly on what is the cost or what is the quantum of that service charge, and what is it that I am going to include in the cost base, what is it that I'm going to use as a markup. Then document the contract and the TP analysis. And this is basically the ideal transfer pricing process that any HQ should follow to make sure that it manages the transfer pricing risk from HQ point of view and from subsidiary point of view. So I think in my experience, the biggest challenge is always about the benefit and how HQ really shows to subsidiary the benefit of that service that HQ or regional HQ is providing. And some key factors that need to be considered from HQ and how HQ really communicates this to the subsidiaries is key in the success of defending the transfer pricing risk in the context of a service transaction. So point number one is the material benefit for the recipient, the commercial necessity for the recipient, the economic and commercial value of that benefit, and that benefit or commercial value being direct to the point that if subsidiary is not engaging HQ for this service, they will be willing to pay to a third party for the service. Because at the end of the day, when it comes to transfer pricing, it's about entering transactions that I will be willing to enter with a third party, especially for services. That can be quite a gray area. So from HQ point of view, really, the two scenarios that we find are the ones that I'm going to discuss in the following two slides. So scenario number one is basically the situation that maybe I have been speaking about until now, which is regional HQ has a true regional team that supports Company C and Company D in a wide range of services. Let's talk about maybe strategic, maybe business development, maybe brand image. And for that service, it charges a cost plus markup service fee to the subsidiaries. So from HQ, there are three issues: how to explain business benefit to subsidiaries and tax authority. And I think here, regional HQ has to be very thorough in explaining to the subsidiaries team why is it that there is an economic advantage for subsidiary to receive these activities. Why? Because at the end of the day, the subsidiary team in an audit situation will be, to some extent, assisting in explaining these benefits to the local tax authority. And that is why the subsidiary needs, or regional HQ has to be very clear about what is the benefit, what is the commercial advantage, and how are you going to explain this to your tax authority. One second issue here, which is going to become more prominent now with COVID-19, is how do we address the benefit test if the services are provided remotely? Because in my experience, and I think once we pass to Gandhi's presentation, he will have his puts on this or his views on it. But in my experience, sometimes the economic evidence or the benefit evidence was in the context of showing the type of deliverables, the email, the travel. And with COVID-19, then we have a little bit of a harder situation because this regional team may be providing the same support, but now remotely. So I think it's going to become even more important to keep the evidence on the benefits in the terms of calls, emails, virtual meetings that were performed to support that subsidiary in that particular activity. And a third key point or difficulty or challenge is to explain the way in which regional HQ determines the service charge. And why is this a challenge in the context of scenario number one, where regional HQ is trying to, say, charge the strategic services to company C and D? Because a lot of the times there is no, in practice, it's really difficult to use the direct method whereby the regional HQ allocates the actual cost incurred in assisting company C and company D and their own operations. Why? Because a lot of the times these teams are shared teams that are looking after not only Singapore, but are looking after 3 countries or 5 countries. So if you are not an entity that records time like we do in consulting, then it becomes really difficult to understand how does the shared team incurs their time or give the benefit of their time to the 5 countries or to the 3 countries. That's why a lot of the times when it comes to regional and shared teams and shared services, you end up with using indirect methods, which basically is nothing different to collecting the cost of the team and then allocating among the 5 entities, or in our example, the 3 entities, the cost of that team, and splitting among all the countries that are receiving the benefit from that team. And a lot of the times, there is a challenge around what is the best way to allocate or divide that cost, because there is very little guidance, not only at OECD level, but also at local entity or local countries' TP guidelines on what is the most appropriate allocation key. Really, OECD, if you go through all the long pages about services, the key takeaway is that the allocation key should be commensurate with the benefit that is received by the service recipient. But that can mean different things. So that's why a lot of the times you end up in very common allocation keys such as revenue, head count, because it's easy to determine the head count, or number of PCs, which has probably, in my experience, what I have found to be the most common allocation keys. But explaining to the tax authority of the subsidiary why we have to go down this path is key to explain why there is nothing wrong with using the indirect method. It's just that it's a practical way to resolve the issue around sharing costs among the entities of the multinational group. Now, one thing that I was discussing actually previously during the rehearsal was some of the challenges around choosing allocation keys. So I am of the opinion that actually when it comes to share teams, if you could afford to allocate your cost based on the time incurred by the team in each country, that will be the ideal scenario. But in practice, it's a really hard scenario to implement unless you have systems in place to do accurate time track of the time spent by the shared teams. But then when we have been in reviews or disputes situations, we always explain that if the system to capture the time is not accurate or is not properly being captured, it becomes as subjective as using revenue as an allocation key, really. So that's why I think one thing that maybe sometimes, because tax authorities maybe are not familiar with the internal situation of multinationals, but a lot of the times we have to go with a practical approach because the multinational group may not be in a position or may not have the systems in place to use different allocations to the most common ones used, which is revenue, headcount, and number of pieces. What is the second scenario that we find from HQ point of view? Is the scenario of having service entities. And scenario number 2 is a situation where we have an entrepreneur. Let's say that this entrepreneur is located in Singapore, and that entrepreneur has set up services entities, and let's say that it has one service entity company C located in Malaysia or in Indonesia. So the challenges in scenario number 2 are slightly different. And I will say that there are 3 key issues when it comes to services entities. One is the basis of the characterization of the service entity. From a tax authority point of view, the first point of challenge will probably be point number 1. Is your entity that you call a service entity or a limited risk entity really a limited risk entity? And that will be the key point to substantiate from HQ, but also from the subsidiary point of view. And that characterization will be based on the functional analysis, but also on point number 2, which is a proper contract that allocates clearly the risks of that company C. And then point number 3 is the markup. But I have to say that point number 1 and 2 are the most challenging one. Once you resolve point number 1 and number 2, number 3 really is a matter of resolving it by a benchmarking, or most likely by a benchmark. So that's basically the second scenario, and this is the different challenges that can occur in scenario number 2. Now, will be my I want to finish and give now the baton to Gandhi with my last 2 slides on 2 key things. What are my key tips to minimize transfer pricing risk? And I will say that this is equally applicable from HQ to subsidiary point of view, but my part is HQ, so I will say to focus very clearly on the benefit test. And as I said earlier, if you're working a HQ, to make sure that you explain really clearly to the subsidiary what's the benefit, so subsidiary understands that they would be receiving a commercial or economic valuable benefit that if they don't receive from HQ, they will probably have to engage a third party to do it. And also being very clear about what is the cost base and the allocation key, and explain that to subsidiaries so they know what is the basis of the service charge. I will say that always there is a lot of focus on the markup, but in my view, the markup is always the last step. The most important thing is the benefits, the cost base, and the allocation key. Why? Because if a tax authority challenges the benefit, they really can deny the whole deduction of the service charge. Whereas if they are only challenging the markup, they are effectively saying that they are only challenging one portion of the service charge. But when they challenge the benefit, what they are indirectly saying is that I am going to deny the full portion of the service charge. So in terms of value and transfer price and materiality of the transfer pricing risk, it is a higher risk to be challenged on the benefit, because it will indirectly aim to tackle or deny the full service charge. Point number 3 is in my scenario number 2, where you have to be a bit wary of these services entities. And the key here is to be very clear about the substance and why that entity is a limited risk entity, as opposed to non-limited risk entity, via function analysis and via clear contract. And that goes to my point number 4, which is the key is the benefit test in the functional analysis, whether in scenario 1 or in scenario 2, to describe the risk or the limited risk characterization of the entity. A couple of issues that I would like to point out now that come from COVID-19 is, okay, we are now in a situation of potentially downturn for a lot of multinational groups. So there are some questions that I have seen being raised by some of our clients. So can we reduce markups that were agreed in the past? And I think with that, you may wanna think about if there is going to be reductions of markups that were agreed in contracts in previous years, then you will have to think about how are you going to change your intercompany agreement, from when are you going to change your intercompany agreement. And obviously that reduction has to be substantiated with a benchmark. If an entity is a low-risk service provider, then is that entity or allowed to absorb losses, or it should earn a guaranteed profit regardless of the economic downturn? And I think probably Gandhi will talk about this from Indonesia point of view, but this is a very critical point for those entities in my scenario number 2, where if they are low risk, I think most likely they are not able to absorb losses. As I spoke earlier, the benefit test with remote services and how do we strengthen that economic value when the service is being provided outside and remotely. And a couple of 3 last points, so I can pass the baton, is if there was a lockdown or a circuit breaker in a particular country, can services be suspended? Can normal expenses be excluded if they are considered non-operational? And maybe if there is a need to do year-end adjustments to account for that potential markup reduction, if I have a good basis to do it, or to manage those abnormal expenses. So with that, I am going to pass the baton to Gandhi, please. So you can talk about from a subsidiary?
The presentations, Adriana, it's a very good one. I will start my presentations to continue the discussions about intra-group service. Just let me share the screen. I hope you can all see my screen properly now. Okay, thank you for confirmations. To continue the discussions about the intra-group service from an Indonesian perspective, I will try to discuss our experience and the regulations about the audit that happen to intra-group services from the service recipient point of view. So intra-group service can be classified into two. So the first one is intra-group service that can be charged, and the other one is services that cannot be charged and are not categorized as intra-group services. So there are three main activities or services that is considered a non-intra-group service, such as a shareholder activity that includes activity performed by a member of an M&E group solely because of its ownership interest in one or more other group members in its capacity as shareholder. So for example, like services to prepare the consolidated financial statements, or services related to the general shareholder meetings, which is the sole purpose interest of the shareholder. And then the next type of non-intra-group service are duplicative service, which means the service is undertaken by one group member that merely duplicate a service that another group member is performing for itself, or that is being performed for such other group member by a third party. For example, if a taxpayer have their own marketing department and perform marketing activities internally, and at the same time, they also receive similar marketing service from related party, then the marketing service can be considered as duplicative service because the taxpayer already have their own marketing department and does not require similar service from other parties. And this type of transactions may be corrected, may be deducted by the tax office during a tax audit. And the third type of non-intra-group service can be incidental benefit, which means the services provided only provide incidental benefit to the group members and is not performed solely for the purpose of that particular taxpayer. So as Adriana has mentioned before in her presentations, that the service must be intended and must be solely used for received by the service recipient. And the next discussion is about low value adding service. So in OECD guidelines, we recognize services that are low value added that have several characteristics. The first characteristic of the low value adding service is supportive nature. And then the second one is the low value adding service is not the part of the core business of M&A group and does not require unique and valuable intangibles, and also does not involve assumptions or significant risks by the service provider. So for example, the low value adding service is like accounting and auditing service, and accounts receivable and accounts payable processing and management service, human resource activities, staffing and recruitment, training, remuneration services, and other services that are not part of the core business of the company. And for services that are the core business of the company, for example, like research and development, manufacturing and production services, sales, marketing and distribution activities, this type of services would be considered as high value adding services. Okay. And during a tax audit, there are three conditions that the tax auditor would see or would check for the payment of intra-group services. First is the existence of the services. The question is whether the services have been actually provided. The tax auditor would verify if the taxpayer have received the service in Indonesia, and will also collect the supporting documents as an evidence to show that the service is actually provided. Maybe in the case of emails or reports or like a travel itinerary documents. And then the next test that the tax officer would like to be interested is the benefit test. As explained by Adriana earlier, that this is one of the most important tests for the headquarter, for the service provider, and it is also important for the service recipient to show that they really receive benefits for these services. After these two conditions have been met, then the tax office will assess the arm's length principle implementations. In this case, the benchmarking analysis prepared in the transfer pricing documentations. And for example, if the taxpayer does not pass the verification and the benefit test, the tax auditor would deem correction to the intra-group service without considering the arm's length principle benchmarking. This is more detailed explanations about the tests that the tax auditor performed during the tax audit. In OECD paragraph 7.5, it says that there are two issues in the analysis of transfer pricing for intra-group services. One issue is whether intra-group services have in fact been provided. This is the existence or the verification stage. And the other issue is what the intra-group charge for such services for tax purposes should be in accordance with the arm's length principle. This is the benefit stage and the arm's length principle stage. After all of these conditions are met, then the tax auditor would calculate the arm's length compensation for the intra-group services. These are the summary of the steps that will be taken by tax auditor when assessing an intra-group services in Indonesia. The first step is to review the basis of the intra-group service charges. And then the tax auditor also will examine what are the components, the cost components for charging the service to the service recipient, and whether the cost component has complied with the service rendered and the economic benefits for the taxpayer. And then they will also examine whether the service charging method is direct or indirect method, how it is allocated to the service recipient, what are the allocation bases used, for example, the revenue or the head count or the area, the width of area, or the number of PC can be explained clearly why that particular allocation basis are selected. After that, then the final step is to examine whether the intra-group services markup is arm's length compared to other intra-group services using a benchmarking analysis. And in assessing the intra-group services, the transfer pricing method that can be used by the tax office are the comparable uncontrolled price method. So the tax office would search for similar agreements for the particular services, or can use a cost plus method or transactional profit method. In this case, a transactional net margin method, to test whether the markup is in accordance with the arm's length principle. All right, so in here we have a case study, a simple case study for us to remember from our morning briefing today. I will read briefly and maybe you can take your time for several minutes to process it internally. PT JKL, a computer hardware manufacturing company based in Indonesia, conducting transactions with its affiliate party XYZ PTA Ltd based in Singapore. In this case, the parent company owns 90% of the shares of PT JKL. XYZ PTA Ltd is a holding company in charge of providing management services to its subsidiaries. During 2020, PT JKL received management services from XYZ PT Ltd in the form of strategic management services provided by the Chief Executive Office XYZ PTE Ltd. The scope of services provided include determining strategic business, including marketing and sales services. PT JKL has prepared a transfer pricing report, a local file for FY 2020, and is currently facing a transfer pricing audit. Pricing policy determined by PT JKL and XYZ PT Ltd is 5% on net sales of PT JKL. During the tax audit, the tax auditor mentions the following argument. The first, management service fee paid by PT JKL does not really happen because PT JKL also has a special division that handles the company's strategic management, so that the services provided by XYZ PT Ltd can be categorized as duplicative services. And the second, therefore, PT JKL should not be able to charge these duplicative services. And correction of costs against the cost of management services of 5% of net sales are considered not accounted for in the operating profit of PT JKL. What should be noted by PT JKL to face the tax audit questions above? All right, so as we have discussed today, there are 3 tests that must be passed by PT JKL, the service recipient in Indonesia, in order for their intra-group services can be accepted by the tax office. The first one is PT JKL must prove that the services they have actually been performed or existence test. In this stage, PT JKL must be able to at least provide the agreements or the invoices and the service report or recommendation received from their parent company and XYZ. They can also show the list of clients or sales leads derived from the marketing and sales services received from the parent company. And the second stage action is PT JKL to prove that they have really received benefits from the marketing and sales service received. For example, they can show their organization chart and explains that they does not have the department and does not have the person who are capable in doing this marketing and sales activities. And also they can show what are the results in the increase of sales and revenue from the marketing and sales services that they receive. And the third actions that PT JKL can take is to prove that their margin is in accordance with the arm's length principle. Of course, this step can be concluded through a benchmarking analysis prepared in the transfer pricing documentations, where in the benchmarking analysis, we will try to search for comparable agreements that have comparable services, and based on that agreements selected, we will derive, PT JKL must derive an interquartile range to show that the 5% commission of net sales is arm's length compared to independent agreements. Thank you. That is my presentations today about the intra-group services audit. And before we go to the question and answer stage, as you are aware from our invitations that we will give a brief highlight about the update of APA regulations in Indonesia. Just for your information to know what are the major changes and things that you need to know about the regulation. Please allow me to switch my screen for a moment. Okay, I hope you can see the APA regulations highlight slide now. Yeah, I will start the presentations now. Can anyone confirm that? Okay, not yet. So I will just try it again if it's not yet there. What about confirming the variation for? Thank you for the confirmation. Okay, this is a brief highlight about the recent APA regulation in Indonesia. Just a pointer of things that you need to know of the new regulation. So the regulation is Per 17 PJ 2020, was issued in 17 September 2020, pertaining to the procedures to complete the applications, implementations, and evaluation of advanced pricing agreements. This Per 17 is the implementation provision for the Ministry of Finance Regulations number 22 about the procedure for implementing the advanced pricing agreement, which was issued earlier this year. So this is only a short regulations. It only consists of less than 10 pages, and there are two important highlights that I believe we need to know. The first highlight is the profitability requirement for the APA period. So in the proposed transfer pricing price in the APA applications, it should be prepared based on the arm's length principle. I think that is clear enough. And the requirement that the transfer pricing that is proposed would not cause the taxpayer's profit level indicator during the APA period to be lower than the last 3 years corporate income tax return prior to the APA period. And the profit level indicator of the taxpayer will be assessed by the tax office using a return on sales or the net cost plus margin. So it is very important for those who are interested in applying the APA to take care that the transfer pricing that is requested in the APA applications will not cause the profit level indicator to be lower than the 3-year CITR. And the second important highlights that is introduced in these regulations is about the financial adjustments related to COVID impact. So in the APA applications, we will prepare financial projections of the company's profitability for the next 5 years, for example, during the APA period. And as we know that today, this year, most of the business are impacted by COVID-19. So the regulations has accommodated the COVID-19 impact on the business profitability. So if we believe that, for example, in next 5 years, that our company is still impacted by the COVID-19 and the profitability or the sales would be negatively impacted, then we would need to prepare an adjustment, a calculations. And the format of these calculations is already attached in the regulations in Per 17/2020. So in that format, taxpayers would need to identify what is the amount of the sales, cost of goods sold, operating expense, other income and expense account projections for the next 5 years that is impacted by the COVID-19, and what is the adjustment that needs to be made for each of these accounts to reflect the normal conditions. And in addition to the calculations or the financial projections, taxpayer also need to prepare a written explanations to build an argument and explain narratively about the adjustments and about the impact of COVID-19 to the income statements, profitability accounts. So that is the two main highlights that it's important for us to know for a takeaway from the APA regulations that is recently issued by the tax office. That is my presentations today. Thank you for participating, and I will return it back to our moderator, Jelita. Thank you.
Thank you very much, Adriana. Thank you very much, Gandhi. That was very interesting and insightful talk today. Adriana, we are happy to have you here today. Thank you very much.
Thank you for the invitation. It was a pleasure. I have learned a lot from all of you and very interesting questions, I have to say.
Thank you.
Thank you.
Ladies and gentlemen, may I thank you very much for your active participation in this seminar. I hope you enjoy the program. Please follow our social media to see the update schedule of our future events. Okay, goodbye and good day. Thank you.